Hello, good evening, everyone. Hello, can you guys hear me?
Evening, evening.
How are we today?
Yo, stressed.
Stressed.
We're stressing about tomorrow, yes.
How was Saturday class? What did you guys cover on Saturday?
They were doing instruments, financial instruments and consolidation, group accounts, yeah. Because I didn't stay long. I can't hear them properly. It's hard for me to understand them.
You didn't stay long, so you guys were just supposed to tell me that let's continue with our class.
Mara, I did say in the morning that it's wasting
Um,
time to attend those
but me,
people.
you see, the thing is, I always want you guys to attend that class so that at least you see something different from how we do things. It also helps at the same time. But anyway, I want us to look at these questions. I'm not sure if we'll be able to finish, but I'll explain. Let me just admit other guys there. Right, so I want us to look at this question. It's assessment 4 for last year. Remember, last year they started from the webinar was assessment 1, which means this is equivalent to assessment 3. Because the last year the webinar was assessment 1. So let's look at how best we can do in the exam, in the test tomorrow, and see how can we be able to answer the question. But what I will do is I'll try to show you guys how you answer some of the questions when they come, because I don't think we'll be able to finish all the questions. But I'll try to explain how do you answer them when they come in the exam. Right, so let's start with here. They say Kunutu Limited is a JSC Limited listed company operating in the construction sector in South Africa. Something is just... The company was incorporated in the early 2000s. Let me just close this. These things that are just popping up on my computer. I don't know where they're coming from. Shit. Let me just close something popping up on my computer. And they are keeping on coming. Right, so they say the company was incorporated in the early 2000 by a CSA, who is the chief financial officer of the entity. Over the years, Kanutu has evolved into a major South African manufacturer, distributor, and marketer of clay bricks, clay pavers, tiles, and a range of building materials. The following information has been provided for the financial year end. So our financial year end, this is also very important. When you begin a question, quickly pick the financial year end. Right, so we have transaction 1 is foreign currency exchange transaction. The moment you go to transaction 1, you should know you are dealing with AIS 21. AIS 21. What does AIS 21 say? So what is important is in FAC, all these standards from AIS 1 to 40, what you need to understand when you are answering a question is all about initial measurements and subsequent measurements. All the standards that you are doing, you are only going to look at initial measurement and subsequent measurement. So which means if you are dealing with AIS 21, you should look at initial measurement of AIS 21. How do you account for an asset or a financial instrument based on AIS 21? And how do you measure it subsequently thereafter? So which means here you'll be following AIS 21 rules, the standard. That's accounting is all about initial measurement and subsequent measurement. So you should know at initial recognition, how do you recognize based on AIS 21? On subsequent measurement, how do you measure based on AIS 21? The same applies to AIS 40. How do you measure an asset at initial recognition based on AIS 40? How do you measure it at subsequent measurement? I think that's all about this accounting thing. Right, but let us look at this, the first one. I think the first question is we need to do the journal entries. If you check, we did a similar question in our class for these journal entries. Let me just go to the question and see. So our first question says, prepare all the general journal entries in the accounting records of Kunut Limited to correctly account for the purchase of the inventory and related foreign creditor in the year ended 31 January 2024. Do you see this journal is a bit different from what we did? If you check what we did last time, the wording of the journal and the wording of this journal are different. In our previous class journal, they did not mention that we only focus on only things that are related to the foreign creditor. If you check the question, it's a bit different from the one that we have here. So what it means now, when you go to your scenario, but this will not cost you marks even if you include unnecessary journals. Remember, they will not deduct marks. They will just mark the ones that are necessary and leave out the ones that are not necessary. Right, so let's check what are they saying about this. They are saying due to a local shortage of French pattern, Charles Kunut Limited to purchase the inventory from a supplier from France. On 5 October 2023, Kunut placed an order, a cancelable order, account amounting to 210, I think it's, I don't know which currency is this one, to purchase inventory from the supplier. The inventory was shipped free on board at the agreed port of departure. The inventory was loaded on the ship on 15 October. So this is your transaction date, but the ship only departed South Africa on 21 October. So you remember when it is free on board, once the goods are on the ship, that is going to be, they are now in the hands of, all risk and rewards are now in the hands of the owner. So which means our transaction date is going to be 15 October here. Then they come here and say the purchase price of the inventory was payable in 2 equal installments of 105 each on 5 January and 5 February. But as we want to do the financial statement for 31 January, so this is another thing that we should look at. So which means here we have another journal here. Here we have another journal here. Then Kunutu sold 40% of the inventory. So this one is not going to be applicable because remember they say in the question, they say we should do journals that are related to the foreign creditor. So this sale is not related to the foreign creditor. So you don't have to mind about this journal. But if the question was saying all journals for this transaction, let's say the question was saying, do all journals that are related to the whole of the transaction in this scenario, then it means we're also going to have this journal for the inventory that was sold. So basically here, what is important when you are answering this question is which journals you have to do your initial measurement, which is on 15 October 2023. Then your subsequent measurement, you take the one for 5 January 2024 and the one for the year end. I think we should also have the journal for the year end. I think those are the journals that we can have here. So let's quickly do, so which means on initial measurement, it's 15 October. We are going to use this. Am I correct? This is the rate that we are going to use when we recognize the inventory. 15.35. So our first journal should be for 15 October. This one is a bonus. If it comes, it will be a bonus. So let's look at how do we present the journals in our so that is our A. So it's going to be our journal entries. Right, so let's look at our first journal is going to be on 15 October 2023. We are going to recognize the inventory. So here, which two accounts are we going to have here? We bought goods on credit. We bought inventory on credit. So which means we have to debt inventory. We bought goods on credit. So which means we have to debt inventory in the statement of financial position. And credit who we bought on credit. So it's going to be trade payable. That's how you determine your journals. We bought goods on credit, so you have to take into account the inventory, and then your double entry will be a trade payable. If it was cash, then it means this was going to be bank. By how much? Remember we say we use 19.35. So it's going to be 19.35 times 210. So this is our initial measurement. How much are we going to have all in all there? 19.35 times 210.
4,063,500.
4,063,500. So this is going to be 4,063,500. So the same applies here. 4,063,500. So we are done with journal, our initial measurement. So from your initial measurement, then you go to your journal 2, which is going to be now our subsequent measurement. So you look from the question, who is going to be your journal 2 from your question. So our journal 2, here we are on 15 October, then which means we are now recognizing the payment. They have down here 105 on 5 January. So this is going to be our journal 2, the payment. And every time when you do a payment or when you close at the end of the financial year, you should always recognize the foreign exchange gain or loss. Every time when your subsequent measurement should now take into account foreign exchange gain or loss. So which means here we should recognize the payment and also look at if it is going to be a foreign exchange gain or a foreign exchange loss. So that is 5 January 2024. So we look at the rate, which is here. Then when you do your foreign exchange difference, which means you are comparing with 19.35. Am I on the right line? Is it this line for 5G? Yeah, it's 19.20. So you compare this with this one to get your foreign exchange gain or loss. So in our case, what are we going to have? This is initial recognition, it's 19.35. And on 5 January, the rand was at 19.20. Is it a gain or a loss? Are we going to have a gain? It's going to be a gain. So which means we just recognize this payment, then we also take into account the foreign exchange gain. The foreign exchange gain. So if this kind of a question comes in your test whatsoever, it's all about your understanding your AIS 20. In FAC, all topics is all about your standards. There is nothing that you use your own understanding. You use the standard, which means the first thing first is to understand what does the standard say. Then you apply that standard to a question. So if you don't know the standard, the first thing is to go to the standard, understand AIS 40, what does it say on the, and in FAC, it's all about initial measurement and subsequent measurement and disclosure. If you look from AIS 1 to whatsoever, especially excluding groups, you find that we're only talking of one thing, that is initial measurement, subsequent measurement, and disclosure requirements. All these standards, they just want you to do those things, right? So this one is going to be on, so which means this is our journal 2 on the payment. The half done payment is 2024. So they paid half and the rate was 1920. So when they pay, what is going to happen? The double entry. We're going to reduce our creditor, which means the creditor is going to be debited because we are reducing it in the statement of financial position. Then we're going to credit bank. Money is coming out of the business bank. So we're going to credit bank in the statement of financial position again. By how much? The rate on 5 January is 19.20. Then they paid 105. So this is what they paid on. Then you are done there. How much are we going to have there? It's 19.20 times 105.
It's 2,016,000.
2,016,000 like this. Okay. Right. So you are done with this one. But remember, on your subsequent measurement here, you now need to take into account the foreign exchange gain or loss. So in our case, we agreed that we are going to have a foreign exchange gain. So it's going to be a foreign exchange gain. So if it is a gain, let me just come here. So which means this journal also falls under 5. So if it is a gain, who is going to be credited and who is going to be? So when we make a foreign exchange gain, it means it's going to reduce our creditor here. So we're going to debt creditor, because the creditor is going to be reduced by a gain in the statement of financial position. Then we credit income. Again is income. All income have to be credited. So here we credit a foreign exchange gain. Remember, I told you guys about the 5 elements. If you understand those 5 elements of financial statement, in accounting, you are done. Double entry, you are done, because all accounting falls under those 5 elements of financial statement. Nothing, if something falls outside the 5 elements of financial statement, then it's not accounting. So once you know that an asset increase on the debt side, a liability increase on the credit side, an income increase on the credit side, an expense increase on the debt side. So what you just need to do when you are doing journal is, in a question, you just need to determine whether you are dealing with the creditor or you are dealing with income. Then you know how to do your double entry. So those 5 elements of financial statements are very important to understand. So which means here you just come and classify. Am I dealing with a creditor? Am I dealing with income? Am I dealing with an asset? Then you know how to do your double entry. Okay, so let's look at now, this one is going to be foreign exchange. We say it's a gain. So which means it's going to increase our profit and loss here. By how much? Remember, we have 1935 against 1920. So it's going to be 19.35 minus 19.20. Then we multiply by 105,000. How much are we going to have there? So this is our journal 3. So it's going to be, how much do you guys have there? It's going to be
I get 15,750.
15,750. 19.35 minus 19. Are we going to use 105 here? We're still using the full amount, am I right? We only use the 105 on the payment, but on the gain we should use the full amount. On the foreign exchange gain, we should use the full amount. So we should use the full amount. So how much are we going to have if we use the full amount there? 19.35 minus 1920
1,500.
times 210,000. 31,500.
Love Mo,
Yeah.
can I ask a question?
Yes.
Why are we using 19.35? Because on the
Okay, let me go to the
it says
question.
that the inventory was loaded on the 15th of October, but only departed on the 21st.
Okay, let me
Why are
just
we
go. Let me go there so that we all look at the question. Okay. We are saying, why are we using 19.35?
0.35?
Okay. Okay. So what do you think we should use here based on your understanding?
Aren't we supposed to use when it's the inventory already departed, because we we can only recognize that the inventory when it's already on shipment, isn't it?
Remember, here, what you should always look at, the moment we load inventory, remember when we use free on board, the moment we load the inventory on the ship, whether it's going to depart after 5 days, 10 days, it's no longer none of our business. We are now, as the moment we load it in the ship, the risk and the rewards are now transferred to the owner. So when it is going to depart, that one is no
Okay.
more going to be end of your business. So which means the moment the ship is loaded, if it was loaded and departed on the same day, then it was going to be fine. We just use the date of loading and departing. But like in this case, you can see here, it was loaded on 15 and departed on 21 October. So in your case, remember when you go to load the ship, you will not wait for it to depart. You just go back. You are done. You've signed everything, which means the risk and the rewards are now in the hands of the owner of the goods. So this is the date of transaction. So that's another thing, especially when you are doing this question, always try by all means to pick this first, because once you get lost from this one, then it means all these journals will be wrong. Yeah. So as soon as the ship is loaded, the risk and rewards are now transferred to the owner. You are no more responsible for those goods. Okay, I
Okay,
don't know
thank
if,
you.
so always look at the wording of the question, free on board. But I think for us, for for FAC third level, we use free on board. There are three, there are two, three. There is one where we should we only accept the goods when the goods are delivered. I forgot the name of I will tell you when I recall the name of that one. There is another one where you recognize the goods when they are delivered. But for us, for FAC 3764, we always use free on board. Right. So here we are done with which other journal are we going to have here? We are done with 5 January. And our financial year is 31 January. What are we going to do on 31 January?
There's a journal there for closing.
Sorry?
There's a closing journal there.
Yeah, well, we close what there on 31 January?
The inventory.
Huh?
Closing rate.
Right. On 31 January, what are we going to do? Remember, at the end of the financial year end, we should always recognize whether there is a foreign exchange gain or loss. At every financial year end, we should always recognize if there is a gain or a loss at every financial year end. So, which means this is the journal that we are going to have. We are going to recognize a gain or a loss at the end of the financial year end, which means on 31 January, we are going to recognize if there is a foreign exchange gain or a loss. So are we going to have a gain or a loss here? This is 31 January, is 20.10. We compare it with who? We have already recorded something here, a payment that was done on 5 January. So which means we compare it with what happened on 5 January. If there was no payment on 5 January, it means we're going to compare it with here. So already we have a payment that was done on 5 January. Then it means our foreign exchange gain or loss, we're going to compare it with the transaction that we did on 5 January. So we compare 19.20 and 20.10. Is it going to be a foreign exchange gain or a loss in this case?
A loss.
A loss.
Yeah, it's a loss. Yeah. So here we're going to record a foreign exchange loss. So this is the journal that we are going to do. Remember, our financial year end is 31 January. So which means we need this journal to record the foreign exchange gain or loss. It's here. That's why I say that inventory journal for sale of inventory, we're not going to account for it. Because the question says, prepare all the journal entries in the accounting records to correctly account for the purchase of the inventory and the related foreign creditor for the year ended 31 January 2024. We were supposed to do narrations. Yeah, they say journal narrations are required. We're supposed to do the narration. So which means that sale of inventory to a local company, there is no space for it in this journal. But if the question was saying prepare all the journal entries in the accounting records to correctly account for the transaction here, then it means we're also going to include that part of the sale of the inventory. So which means our journals will end here on 31 January. That's where we end the journal. So our journal 4 will be for 31 January, and we've already sold some of the inventory. So which means our foreign exchange difference now is going to be on our journal 4. We say it's going to be a loss. How do we record a loss in our journal? A loss is going to increase our creditor. Am I correct? Yes. Then the foreign exchange loss is going to be an expense. So we debt expense and credit the creditor. So it's going to be foreign exchange loss. That's how you determine a double entry. Foreign exchange loss in the profit and loss. Then we debt creditor. Because if it is a loss, it's increasing the creditor. So we credit the creditor, sorry, in the statement of financial position by we have 20 19.10 minus 19.20. Then the loss that we are now accounting for, the closing one, is now focusing on the remaining inventory. So this is how you present your journal or your closing journal. So how much are we going to have there?
94,500.
So this is going to be your 94,500. 94,000. So we have a gain. So even if the question says now, there's a question that we are going to do down there, which says, let me just go to the question. It's B. B says disclose the profit before tax note in the financial statements of Kunut Limited for the year ended 31 January 2024. 20 marks. This marks, if you check, if you understand your standards very well, it's possible to get something out of it. Because if you are to go to the profit before tax note, what do we record in the profit before tax? In the profit before tax, in the profit and loss, we only need income and expense. So this question is not that difficult as long as you know what is required in the profit and loss, which means in all your transactions, when you are doing B, you go to transaction 1, who is income, who is an expense. You are done. You go to transaction 2, who is income in transaction 2, who is an expense. That's what you will be doing. You go to you just look for anything that is income and for anything that is an expense, because profit and loss is all about income and expense. If the question could have said disclose in the statement of financial position, then it means you are going to look for the statement of financial position is all about assets and liabilities. So which means in all your transactions, you are going to look at who is an asset and who is a liability. Then you take them to your statement of financial position. That's all about this disclosure. So when you see this, don't take it as if it's a mountain that you cannot climb. You just need to understand your standards. Like now, if we are to disclose the profit before tax note, it means we have already done something here. What are we going to take here to the profit and loss? We have already done something here. We have a foreign exchange gain here. It's going to be income. We have already done a calculation here. Then we have a foreign exchange loss. It's going to be an expense in the profit and loss. So which means you just pull these figures to your profit and loss, to your disclosure for profit and loss. Foreign exchange loss, if you want, you can net them. You can net them. You can take the foreign exchange loss gain minus from this one. Then you are left with the foreign exchange loss net balance. Or you can still record them under this one under income and this one under expense. Then you are done. So which means B, on our transaction A, we already have our answers for transaction A. Right, so let's look at what else are we going to disclose there in the profit and loss. Let's check on, okay, let me just come down here and say, when you are disclosing, then it means you need, this is going to be your B. It's your disclosure. So which means you need your name of the company. That is there. Then what do we want is the notes for the year ended. Notes for the year ended. Our year end is 31 January 2024. Our note is going to be the profit before tax. So you just come here. The profit before tax include the following. Right, so this is how you present your note. Then you come and tell us what is going to be included in your profit before tax. So in profit, we only have income. So which means you are going to have income. Who is income? Then you are also going to have your expenses. Right? Then you can now do your calculations down here. Right. Before you even do your calculation, I would prefer you to go to every transaction and pick what are you going to have in every transaction, so that when you do your calculations, you know what are you calculating. So transaction one, we say we have a foreign exchange gain and a foreign exchange loss. That is on transaction one. Then you go to transaction two. Let's look at transaction two. What are we going to have on transaction two? They say paver production plant, original cost price, carrying amount. So this is the carrying amount. The plant became available for use as intended by management on 1 February 2021. The residual value of the plant is considered negligible and remained unchanged throughout the period. On 31 January 2024, there were indications that the demand, the moment you start to read about any machine, that there were indications that demand for the paver produced by the plant had decreased. We just know what is coming here. Impairment loss. That's the indication that the asset need to be impaired here. Then they say it was estimated that 33,000 units of paver could be produced annually by the plant over its remaining useful life of 8 years. The selling price per unit is estimated at 45, while the production cost per unit is estimated at 25. On 31 January 2024, broker indicated that the plant could be sold on the open market at a price of 3,500,000. A fee of 5% of the selling price will be paid to the broker to conclude the transaction. A pre-tax discount of 15% per annum compounded annually is regarded appropriate. What are we going to have here to our profit before tax note here from this transaction? What are we going to have? What are we going to have to our profit before tax? This is how you answer that.
Loss.
Sorry? We want to pull through something from here to the profit before tax.
Impairment loss.
Yeah, we are going to have impairment loss. And what else? Depreciation of the plant, obvious. It's another thing that we are going to have here. So which means here, we are going to have impairment loss and depreciation of the plant. So what it tells us now is you need now to do a calculation for depreciation for the plant. Because once you identify what goes to profit and loss, then you can now do a calculation for them. So which means in this case, we have impairment loss and depreciation. Right, so on our income, we can have what? Here we already have on transaction one, foreign exchange gain. You can net this one because there is a gain and a loss. But let's just put them like this. Then here we have foreign exchange loss. So this is going to be your A. You take it this one from A. You take this one from A. Then on transaction two, we say we only have expenses. There is impairment loss. And we also have depreciation. Right, so which means now in our calculations, we need this impairment loss and the depreciation for the plant. I think we should start with this calculation. For us to be able to do impairment loss, we need the depreciation. So let's go to the question and see how do we arrive at the depreciation for the plant. Right. The question says, but there's something that I want us to look at, because before you answer this, you should also look at here. Additional information. We can get something out of it. They say Canund accounts for inventory at the lower of cost and net realizable value according to AIS2 inventories. They account for property, plant, and equipment on the cost model with AIS 16. Depreciation is accounted for in accordance with the straight line method over the estimated useful life. So which means that plant, we are going to use this line. It falls under AIS 16 and we account it using the cost model, depreciation on the straight line. Then they also say Kunund accounts for investment property using the fair value model in accordance with AIS 40 investment property. So if there is any investment property, I think you guys will know how to differentiate between a PP asset and an investment property. So that in the question, you can quickly see this is a PP asset and this is an investment property, so that you can use the fair value model. The fair value model is all about how do you measure investment property in your initial measurement, and how do you measure it subsequent measurement. So which means in your subsequent measurement, you just look at the fair value adjustment. What was the value at initial recognition and what is the value at year end? Then the difference is going to be your fair value adjustment. If you are to go to the profit and loss, which means that fair value adjustment, just take it to the profit and loss as income. So that's basically there. Then they say Kununtu discloses interest income within the profit before tax. The South African normal tax rate is 27 and the capital gain tax inclusion rate. If you are to do your deferred tax, then you need to take this into account. The tax rate has remained unchanged since 1 February 2021. Deferred tax is provided on all temporal difference using the statement of financial position. So if you are required to do a deferred tax, it means when you are using the statement of financial position, who is an asset in the question? Who is a liability in the question? Then that's where you get your deferred tax from your assets and your liabilities. Then they says there are no other items causing temporal or exempt difference except those mentioned in the question. You may assume that Kununti will have sufficient profits in the future against which any unused tax losses can be utilized. Tax losses. The tax loss for this year will be claimed in the following year. So which means in the following year, it's going to be a deferred tax asset. I think you guys will know this when we were doing AIS 12. If you check AIS 12, it deals more on these unused tax losses. Then they say all amounts are material and you may ignore the implication. So what we want here on this plant, it means we are going to use the cost model. The cost model is cost less accumulated depreciation. Then we have the carrying amount of the asset. That's the cost model. The fair value model is the cost plus fair value adjustment. So that's the fair value model. Right. So in this asset that we have, what is going to be our we said here we need impairment loss and depreciation. So let's look at the depreciation for the plant. The residual value of the plant is considered on that one. There were indication that, okay. So then they come here and say it was estimated that 33,000 units of paper could be produced annually by the plant over its remaining useful life of 8 years. The selling price per unit. So here we want their depreciation for the plant. What are we going to do to get? The machine is having a remaining useful life of 8 years. On 31 January 2024. So how do we arrive at the depreciation? I think when you want to calculate your depreciation here, you can use two methods here. You can use the remaining useful life, which means you are now focusing on this figure, or you can use the full useful life, which means you are now focusing on the original cost. If you are using the full useful life, you can see here on 31 January 2024, the machine had 8 years remaining. So you count going backwards to 2021. So you look at 2021 to 2024, there is 3 years plus the remaining one. So which means it's going to be 11. Then if you want to use the remaining useful life, the 8 years, then it's going to be your 8 plus 1 year for the 2024 financial year. So which means you are going to use 9, but you should be now using this figure. That's how you determine your depreciation. Right, so let's look at what is going to be our depreciation. I think my space can be small. Just this. Right, so our first calculation is going to be, we need our depreciation on the plant. That is going to be our calculation. We need the depreciation on the plant. So the cost of the plant is, we need the cost of the plant is 4,950,000. So if it is the cost, then what is our carrying amount on 31, on 31, so we need carrying amount. What is the carrying amount on 31? It's 4,050,000. Am I correct? So which means our accumulated depreciation is going to be how much? It's going to be the difference between these two. What is going to be our accumulated depreciation there? 4,950,000 minus 4,050,000. So our accumulated depreciation is going to be how much here? 900,000. Right, so our depreciation for the year is going to be 4,050,000. There is no residual value. So what is going to be our depreciation for the year? Are you guys there? Divide by 9. Are we still together, or are you guys, you are lost, or I'm alone now? What is going
We
to
are
be the, are we still together? What is going to be the depreciation here? 450,000, am I correct?
Yes.
Then we need now the carrying amount on on 31 January 2024. So we minus there to get the carrying amount. How much are we going to have? It's 4,050,000 minus 450,000.
3.6 million.
3,600,000.
Yes.
Right, so this is the carrying amount. So in our case there, our disclosure for depreciation, it means we're going to take this one. So what is left now is, we say we're going to have impairment loss. So for us to get impairment loss, what do we do according to AIS 36. We need to compare between the carrying amount of the asset and the recoverable amount. And the recoverable amount is going to be the higher of the fair value less cost to sell and value in use. So which means here we want the recoverable amount. So the recoverable amount is the higher of fair value less cost to sell and value in use. So we need these figures. So you see, if you know your standard, it's not going to be complicated, because for you to calculate impairment loss, you need to compare the higher of fair value less cost to sell and value in use, which means whoever is going to be higher between these two, then is now the recoverable amount. The difference between the recoverable amount and the carrying amount is now going to be the impairment loss. So in our case, we need the fair value less cost to sell and the value in use, so that we can see who is the higher. Right, so let's go to our scenario and see who is the fair value less cost to sell and the value in use. Okay, so let's check here. We want the fair value less cost to sell. So the fair value is the open market price, which is 3,500,000. A fee of 5. So this is going to be the cost to sell. So you can just come here and say your fair value less cost to sell is 3,500,000 times, you can say 5% from 100 times 95%. If you want, you can say 5% of this one, then you minus it again from this one. But it's straight to do it like this. So this is going to be your fair value, less cost to sell. Then when it comes to value in use, we are not provided with value in use. So here you need to know what is value in use. Value in use is the present value of the income that is going to be generated by the plant. So which means you need to determine the present value of the income that has to be generated by the plant. That is going to be your value in use. It's going to be the present value of the income. So if in the question they don't give you the actual amount of the value in use, then it means you need now to calculate the present value of the income. So I think we are going to get it here. It is estimated that 33,000 units of paper could be produced annually by the plant over its remaining useful life. The selling price per unit is 45, while the production cost per unit is 25. So the difference is now 25 minus 45 minus 25 times this one is going to give us the income. So we need to determine the present value of that income. Then what are we going to take as our, because we are going to have interest, we already have it as 15%. Then we also need our N. N is going to be the remaining useful life, which is 8 years. Then we also need, who else do we need? If we can have 3, we'll be fine. We can do our calculation. This one is going to give us PMT. So our PMT is going to be the income here. Then we can now calculate the present value. So this one is going to be 33,000 times 45 minus 25. Then that is going to be our PMT. I think we can calculate, once we have 3, we can calculate the present value. So our present value is now the value in use. Remember, the value in use is the present value of the income that is generated by the plant. That is going to be our value in use. So every time if they don't give you the value in use figure, then it means you need to determine the value in use figure by calculating the present value of the cash or the income generated by that particular plant. Right, so that's there. So which means in our case, we are almost there. So let's check how do we figure this out in our answer now. Let's check. So here we already have our depreciation for the plant. It's our C1. It's 450,000. This we already have it as what is this one? It's 94,500, the foreign exchange loss. So our C2 is going to be our impairment loss, the one that we want to do now. So let's calculate the fair value less cost to sell. Is easy to calculate. It's going to be 3,500,000 times 95%. So that is going to be the fair value less cost to sell. How much are we going to have as our fair value less cost to sell?
3,325,000.
3,325,000. Then our value in use, we say we are going to have our value in use is going to be, we have the interest, which is 15%. Let me say value in use. Then we have our PMT. Our PMT, we say we're going to say 33,000. It's 33,000, yeah. Times 45 minus 25. So this is going to give us our PMT. How much are we going to have? It's 20 times 33,000.
660,000.
So this is going to be 660,000. Then we say we need N. The remaining useful life is 8. Then we can punch and get the present value. That is going to be our, yeah, there is no need for negative whatsoever. Whatever punching you do, you get the correct answer. If you, even though you will have something with a negative, but you are still going to get the correct answer here. The problem only comes when you have future value, all those. That's when you have to be careful about the sign. So how much are we going to have as our value in use? the present value. You can punch it on a financial calculator. This one needs a financial calculator. Yeah, you guys are taking long to calculate this. You won't finish in the exam.
I get 2,961,632.
2,961,632. You see, the thing in our exam, if you find that sometimes the exam is not much difficult, but sometimes what makes us fail is not because the exam is difficult, the time. Even on myself, I'll be looking at the time. The time. Me, I always think the time allocation, especially for make FAC, I don't think it's fair. It's always like it's too small. So that's another thing. So we need to train ourselves to be a bit fast so that we don't, at least you don't finish, but you answer at least 80% of the paper. Right. So what is going to happen? Remember, we say the recoverable amount is the higher of. So which means this is going to be our recoverable amount, 3,325,000. Then from there, we are now going to have our impairment loss. So our impairment loss is the carrying amount of the asset, which is 3,600,000, minus the higher of the fair value less cost to sell and value in use, which means it's minus this one, 3,325,000. So this is going to be our impairment loss. How much are we going to have as our impairment loss? So it's 3,600,000 minus 3 million
275,000.
2.
75,000.
So this is going to be 275,000. So that is going to be our impairment loss. So which means here we are done. We are done here. We go and fill in. So our impairment loss is 275,000. It's an expense. Then we go again to the question. We are done with 1 and 2. Remember, we're disclosing them in the profit before tax note. So we are done with 1 and 2. You go to 3. You check what are you going to have on 3. So on 3, we have the waterfall seat property. This is where you should be able to identify whether you are going to apply AIS 16 or AIS 40 on property. So let's look at this one. Does it fall under AIS 40 or does it fall under AIS 16? Remember, you should be able to identify a PPE asset and investment property. So let's look at here, what do we have? They say Kunund purchased a 10-story building in Waterfall City on 1 February 2021 for a cost price of 4,200,000. From 1 February 2021, 9 of the 10 floors were let out to tenants at a fixed monthly rental of 10,500 per month per floor, while one of the floors was occupied by Kanutu. The 9 floors were fully occupied through the current year. The estimated useful life of the building was estimated to be 30 years and a residual value of 300,000 was allocated to it. The fair value of the property was as determined by an independent zone appraiser were as follows. So this is the fair value of the property. Automatically, it tells you these guys are renting out this 9 out of 10. One is insignificant. So automatically they are renting out. It's an investment property. So you are going to measure it under AIS 40. Your initial measurement, you take this on the cost on 1 February 2021. Then your subsequent measurement, we are in 31 January 2024. So you just compare what happened here. It was 4,350,000 and it's now 4,500,000. So the difference is what you take to the profit and loss as your fair value adjustment. Then what else are we going to have here? This is investment property. So we also need to take account of the rentals here. There are 9 floors that are rented out. So which means each floor is 10,500. 9 floors times 10,500 per year times 12. So here we have rental income and the fair value adjustment. Those are the only two that we are going to have here. Rental income and fair value adjustment. Are we together? So the first thing is for you to know which standard are you going to use here. You are going to use AIS 40. So which means here you are going to determine the fair value adjustment. Right? So let's see how do we, this one, how do we record it? Okay, let's check out. So when a question says disclose, there is no way you cannot find something to disclose in the profit and loss. In your scenario, you have to find something, even though you're not going to get 20 out of 20, but you must get something. Right, so here we have rental income. It's an income. Then what else do we say we have? Fair value adjustment. So we need the fair value adjustment also here. So our fair value adjustment is going to be 4,500,000 minus 4,350,000. It's how much here? It's 150 here. So this is going to be your fair value adjustment. Then your rental income, it's 10,500 per month times 9 floors times 12 months. So this is going to be your rental income. How much are we going to have under the rental income? It's going to be 10,500 times 9 times 12.
1,134,000.
So this one is going to be 1,134,000. So you are done there with the investment property. So we are done with the investment property. Unless if there's someone with a question, we can look at another one again. So you see, these things is all about knowing your standards. If you know your standard, to apply them, I know it's not, I cannot say it's easy, but you can be able to apply them as long as you know your standards. FAC is all about accounting standards. We don't think anything outside the standards. We just apply what does AIS 40 say, what does AIS 16 say, what does AIS 21 say, what does AIS 8 say. So that's basically our accounting. So which means the first thing for you to be comfortable when you are answering your questions in the exam, understand your standards first. If you are struggling with the standards, don't go to questions. First, go and understand what does the standard say, so that when you go to a question, it's easy for you to split what do I take and how do I take it as well, because that's what the standards say. All right, so let's look at number 4. It's bonds, investment in bonds. Investment in bonds. So these guys, they invest in bonds. What do we expect from an investment in a bond? We invested in a bond. So which means here we're going to expect we invest.
Interest income.
Yeah, it's going to be interest income here. So which means this is what you are going to take to your disclosure there, the profit before tax. You need to take the interest income to your disclosure. Then let's look at what they say so that we can be able to see if there's anything else that we can take. But automatically, if it is an investment in the bond, then it's interest income. If it is, remember, this is a financial asset. If you invest in a bond, it's going to be a financial asset. If you sell a bond, it's going to be a financial liability. So which means it's going to be interest expense. So in most cases, when it comes to financial instruments, the first thing when you read a question, is it a financial asset or a financial liability? Because the question does not tell you whether it's a financial asset or a financial liability. So the wording of the question will tell you that this is a financial asset or this is a financial liability. Then you know you take interest income or interest expense. Okay, so let's look at how does this investment in the bond say. It says on 1 February, Kunutu purchased bonds in Mapula Limited at a discount of the face value of the bond. So they were discounted by 4107 of the face value, which was also the fair value at this date. So we already have our fair value. The discounted bond price is going to be the fair value. Then a coupon rate of 12% per annum is payable. Oh, another thing here. A coupon rate of 12% per annum is payable biannually in arrears on the last day of July and January. The bonds will be settled at their face value of 500,000 on 31 January 2028. So which means the bond is for 5 years. But what you should look now is 2023 to 2028 is 5 years. But look at here. When you do your N, you must be careful here. Your N is not going to be 5 because PMT is biannually. So which means it's going to be 5 times 2. So your N is going to be 10 here. Right? Then what else? Your present value is going to be the discounted bond, the discounted face value. So which means the face value is 500,000 minus this one, then it gives you the present value. But let's check again on your present value. This is an investment in a bond. So which means transaction costs which were paid by the investor, you are going to capitalize them. So this one is also going to increase the present value. You should always look at who paid this transaction cost. You may find that in some of the questions, they can come here and say, the one who sell the bond is the one who paid transaction cost. So in that case, it means you don't capitalize them. You look at who paid the transaction cost. So if the bond holder is the one who paid the transaction cost, then it means this transaction cost we are going to capitalize them. Right, so let's look at another. So in our present value, it means we add this to this and minus the discount. Then it's going to give us the present value. So which means we already have our present value, already have our N. Then they say Kununtu holds these bonds with a business model whose objective is to collect contractual cash flows consisting of interest and principal. How do we measure this bond initial measurement and subsequent measurement if it is of the business model whose objective is to collect contractual cash flow of interest and principal? How do we measure it in initial measurement and subsequent measurement? It means we are going to measure it at fair
It's
value.
amortized.
Yeah, it's at initial measurement, you measure it at fair value. Then at subsequent measurement, you amortize. You measure it at amortized cost. Amortized is like the difference between your coupon rate and the market rate. Then that is going to increase the value of the bond. That's the amortization that you have. So which means if the coupon rate is 12% and the market rate is 14%. So it means every year the 2% is amortizing every year. That's what we call measure it at amortized cost. Right. So in this case, it means what is that we don't have? I don't see the market interest rate here. So this one is going to be the future value. So we already have our future value. Our interest, where is going to be our interest here? I think we should calculate the interest here. We don't have the interest here. Right, so here it's going to say the investment in bonds were not considered to be credit impaired at any stage. The 12-month expected credit losses were estimated to be 13,500 and 15,000 on 1 February. So this one, remember we did a topic on credit loss allowance. So this one is going to be an expense. Impairment of these credit losses are going to be an expense. So which means we are going to take interest income and impairment loss, credit loss adjustment here. So these are the two things that we are going to have. We are going to have interest income and credit loss adjustment. So in our interest income, I think we need only the present value and the interest percentage. Then we can have the interest income. There is no need for amortization table here because remember we want to disclose it in the profit before tax, which means once we have here, we just say times the interest rate, then it's going to give us the interest income. Yeah, I think that's there. So let's see how do we do it on. Right, so the first thing I want us to look at to calculate the interest. So we want to calculate the interest. This is going to be our C. So our C what? C3. So here we want the interest. The market rate. So we need present value, FV, N, and who else? PMT, so that we can be able to calculate the interest. So what is going to be our present value? Remember, we say the present value, we have to discount the bond. So which means our present value is going to be our 500,000 plus transaction cost plus transaction cost of 5,000 minus the discount. The discount is 40,107. So this is going to give us the present value of the bond. How much are we going to have as the present value of the bond? $40,107.
400.
Yes, 464,893.
893.
Yes,
Yes.
464,893. Then the future value is that 500 is the 500,000. That is the future value. Then our N, we say our N is the bond is from 2023 to 2028, but it's biannually. So we multiply by 2. So our N is going to be 10 here. Then our PMT is 12%. So our PMT is going to be 500,000 times 12%. But remember, once we do this, then we should also take note of that biannually. So in this case, it means how much are we going to have if we say times 12, then we divide it by 2 to get the biannual one.
It will be 30,000.
I don't know if you guys understand what I'm trying. Because here we're talking of biannual. So which means we should, we should divide by 2. So it's going to be 30. Then our interest, we can punch in. This is a bond, a financial asset. So when you buy a financial asset, it means your PV is negative. Your future value, you are going to get it. It's income. Your PMT is income. So your FV and your PMT are going to be positive here. Then this one is going to be negative. These are some of the most important things when you are doing your calculations for interest whatsoever here. So that the financial calculator will give you a figure. But at the end, it might be wrong and it gives you everything wrong throughout that you are going to work out, especially when you are required to do the journal entry. So what is going to be our interest?
I get 6.99, 7%.
Yeah,
If
let's
you
make
round
it 7% for easy. Let's make it 7%. You see, we have our interest now. So it's now going to be easy for us to calculate the interest. This 7% is paid biannually. So which means per year is going to be 14%, but as we are working on biannual. So which means we are going to say 7% of this one is the interest. Let me just go to the question. There's something that I noticed on that question. Mm. Let me check what the question is saying here. That what we want is the interest. We want the interest per annum. Yeah. So which means we are looking at so here we are looking at what? The interest is 7%. So it's going to be paid in at the last day of July and January. So which means we are going to have two here, two interest. The one is going to be last day of January. It's Feb 2023. And here, last day of July is going to start from 1 August. So those are the dates for payment. So let's see how do we calculate those interests. So we have 7%. So our first interest is going to be 7%. So our first interest is our first interest income is going to be 7% times 464 893 is going to be how much this one? 464 893 times 7. So this one is going to be how much? 32,540. Can round it to 43. 32,542.51. Let's round it to 43. 32,543. This is for the first 6 months. Then we want the one from 1 August. What are we going to do to get the one from 1 August? If you look how we do our amortization table, when we do the amortization table, what do we do when we go to the following period? Then it means you come here. So which means here, you are now going to say, this is the interest, and this is the PMT. So the difference between this interest and the PMT is going to increase this amount. Then you apply your 7%. So it's going to be 32,543 minus 30,000, then you plus 464,893. Then this is the one that you are going to multiply by 7, what you get. So we need here. I don't know if you guys see what I did here. Remember when we do the amortization table, you come here and say, in the following period, you come and say the interest minus the PMT, then you add it to here, then you apply your percentage, then you get the interest for that particular period. So that's what we do here. You can even do a small amortization table if you want here. You can have a small amortization table, but it's not even necessary if you just want one line. So how much are we going to have there on the second one there? $32,772. So which means now we are now going to take these two, 32,543 plus 32,721. That's the interest income.
I get 65 to 64.
So this is interest income. Let's take it here. So it's going to be our 32,543 plus 32,721. You say you got how much here?
65 to 64.
65,264. Then what else do we have on the bond? We need the impairment. So the impairment is going to be an expense. So on that bond, we are going to have impairment here. So that one is going to be our expense. Let's check how do we do the impairment of the bond. So when you do your impairment of the bond, here it was straightforward. I think they give us the figures. But remember, if they say, like in our case, they say, the investment in the bond were not considered to be credit impaired at any stage. So which means we are going to use the 12-month expected credit loss. If there was a significant impairment, then it means we use the lifetime of the bond. So in this one, we're going to use the 12-month expected credit loss, which means it's going to be 13,500 and 15,000 on 1 February 20. So this one is for 1 February, and this one is for 31. So what you do when you have this kind of, it means the one for here, you take it, which is going to be 13,500 plus the increase. Then it's going to be plus 15,000 minus 13,500. So which means you take the one for at the beginning of the year, the one at the end of the year. Remember, when we impair, we will have a percentage at the beginning of the year, then another percentage at the end of the year. But when you record the one for the end of the year, it means you need now to check the difference between the one at the end of the year and the one at the beginning of the year. So this is how you do your impairment. Right, so which means here we are going to, this is going to be the a bond is an expense. This one is going to be an expense. So it's going to be 15,000 minus 13,500 plus 13,500. So how much are we going to get there on the bond? It's still going to be 1,500. So it's still going to give us 15,000. Am I correct? Right, so that one is done. So that's how you do your impairment. You remember here on this impairment, it can requires you to do journal entries. Those credit losses, journal entries. Right, so let's look at the last, or let's look at the next. The next transaction that we can take to the profit before tax. So we were on the bond. Unless if there's anyone with the question on the bond, let's look at the next transaction. Unless you guys have a question on the bond, so which means we are going to employee benefits cost. This is one of the most interesting question, but employee benefits, what I would advise you on employee benefits is understand what does AIS 19 say. Then this question is not always structured in the same way. But whenever you read a question, you must understand the requirements of AIS 19, employee benefit. What are the short-term employee benefits according to AIS 19? What are the post-employment benefits according to AIS 19? How do you accrue leave? Remember, when we were doing this, we say any unpaid leave, any days that are still accruing at the end of the financial year end must be accounted. So which means here, the leave day balance is on 31 January 2024. The company is owing this to this employee for 222 days. So you must account for this in your books of financial statement. Here you are now going back to the accrual concept. Remember when we do the accrual concept, we say we have to record a transaction in the period in which it occurred. So which means if the leave accrual is for the financial year end 31 January 2024, it must be accounted in the books for that particular period. So that's why you see, we now say, even if the employee did not take the leave, but we are still going to take it as an expense for that particular period. So basically, when you do employee benefits, the most important part, which I see in most of the questions, these defined contribution plan are not a problem. The problem is this short-term employee benefits, mostly in terms of leave. When you look at the leave, what you look at is what is the balance that the employee did not take at the end of the year. So which means that the company is owing that balance, and you should pull that balance to the short-term employee benefits in that particular year. So that's basically how you do when you are doing your employee benefits. But let's look at this question or explain some of the things as we go the question. But when it comes to employee benefits, read and understand the question, because the question normally will be telling you, like here, number of employees, we have 70. Then leave days balance at the end of the year, 222 days. So the company is owing 222 days. Then average monthly gross salary expense 1,250,000. It's a monthly one. Average monthly defined contribution plan 250. 40% of employee contribution. So which means here your defined contribution, you don't mind about. Remember here we're looking at the total cost to company. So you are looking at the total cost to company. So what was contributed by the employee is nothing to do with you when you look at the total cost of the company. So when you go to your defined contribution, you just focus on what was paid by the company. So the 60% is the one that you focus on here. And they say salaries are paid on the last day of each month. You may assume that there are 260 working days. So this 260 is very important because when you want to determine what is the company owing, it means you need to average your salary per year by 260 so that you can get the salary per day. Then you multiply by this to get the leave accrual. Right, so here they say you may assume that there are 260 working days in a year and that all employees receive the same remuneration. Kunund pays the monthly pay-as-you-earn taxation amounting. This has nothing to do with employee benefits because the company deduct this. Pay-as-you-earn is not a cost to the company. It's a cost to the employee because the company is just there to act as an intermediator between SARS and the employee. So this one is just there to confuse. It has nothing to do with employee benefits. Then they say all employees are entitled to 20 days leave per calendar year, which is forfeited if not been taken by June of the following calendar year. So this is another very important part. If employee do not take the days by June of the following year, these days will be forfeited. They will no longer be available these days. So when you are doing your question, this is one of the statements that you should look at. Who are those days already been forfeited because they were not taken? Then you need to account for that. Then they say upon termination of employment, any accumulated leave that has not been taken is paid out to the employee. So remember we did, when we were doing our class, we say we have vesting and non-vesting. So which means here they are talking of vesting. You can accumulate them even on termination, which means they are vesting. Non-vesting, if an employee is having outstanding leave days, but is terminated, you will not get, those are non-vesting leave days. Right, then they go on and says, does not expect any termination for the year ending. The leave pay provision was disclosed. So this is the one for last year. So as long as you have a liability for last year, for leave provision for last year, it means when you do your leave provision for this year, you now focus on the movement. The one for last year and the one for this year, then you determine the movement between the two. Sometimes you may find that you don't even, if you don't want to record the movement, you can just record this one, you cancel this one for last year, then you bring in the one for this year. It's still going to be correct. It will give you the correct answer. Right, then they say, Kunut Limited estimate that 50% of unutilized leave on 31 January will be utilized during the year ending. This is where you get also your answer. These 222 days, only 50% is going to be utilized. So this is what the company is owing on accrued leave. 50% of 222 days is what the company is owing here. So that's why I'm saying when you are doing employee benefits, you just have to understand the question. Read the question, understand the question. The question will tell you what to do in most cases. But in some of the questions, you may not be given these leave days that are due, which means you need now to calculate. They will give you information to calculate and unused leave days. So which means you need to calculate the unused leave days so that you can determine the leave accrual. You need to determine the unused leave days so that you can have the leave accrual. So that's all on employee benefits. So in our question here, it means we are going to have short-term employee benefits. And what else? We are going to have short-term employee benefits and the post-employment benefits, the defined contribution plan. These are the two that we are going to have, which we take to our profit and loss. So which means we have our so that's how we answer this. You see this 20 marks, we have to work for them for them. It's not easy to it's a lot of work. Right, so let's see how do we do this employee benefits. So in our employee benefits, we are going to have short-term employee benefits. We're going to have short-term what makes up the short-term employee benefits is the gross salary for the year. And we also need the leave accrual. So you can come here and say leave accrual current year. Then you can say leave accrual for last year. Right, so that's the short-term employee benefit. So what is going to be our gross salary here? So let's look at the gross salary that we have. So from the gross salary, we are going to have 1,250,000 is the average monthly salary. So it's going to be 1,250,000 times 12. That is going to be the gross salary. Then our defined contribution, it's going to be 40% employer contribution, 40% of 60% of this one is per month times 12. So it's going to be 60% of 250 times 12. That's the employer contribution. So which means here on on the gross salary, we are going to have 1,250,000 times 12. How much are we going to have there?
15 million.
So this one is going to give us 15 million. The leave accrual. So let's look at the last year's leave accrual is the one for last year is so this one you cancel it. The one for last year, which is I saw it somewhere. 41. The leave pay provision for 2023 is 41,026. So this one you are going to cancel it. So this is going to be we don't have the current, we have the one for last year. 41 026. Then the current leave accrual, the current one, right? There is another thing. If you go to your notes there, you will see that when you do the current leave accrual, remember this is going to be paid in the following year. So which means when you calculate your salary per day, you need to use the total cost to the company. So which means this post-employment benefit is going to be part of the remuneration. If you have done, when we're doing, what do you call it, the tax, if you check when we're doing employee tax, we had to calculate the balance of remuneration. Remuneration and basic salary are different. When it comes to remuneration, it means all employee benefits are going to be included to get to remuneration. But when we talk of gross salary, we're talking of your salary like your hours and all other stuff. So which means when you calculate the leave accrual here, you need to use the remuneration, which is going to include the salary plus other benefits. So your post-employment is going to be 250,000 is per month, and the company is contributing 60% times 12 times 12. So this is going to be the post-employment. How much are we going to have there? $250,000 times 60% times 12. 1, 2, 3 is 1,800,000. So this is going to be your post-employment benefit of 1,800,000. So when you calculate your leave accrual, you should take this as part of the salary. I don't know if you guys were together here. So when you do your leave accrual, so let's look at how do we determine the leave accrual here. So our leave accrual says 50% is the one that we should be owing. The rest are going to be forfeited. That's what it means, because only 50% is going to be taken in 2025. So only 50% will be utilized during the year ending 31 December. So the rest will be forfeited. So 50% of 222, this is what the company is owing in terms of leave. So how many days are we talking about here? The company is owing how many days? Is expecting to pay how many days here? So it's 222 times 50%. So the company is expecting to pay 111 days here. Then when you have your 111 days, what are you going to do? You look at the salary per day. So your salary per day, our gross salary is it's how much? It's 15 million. Then plus employer contribution to, they are contributing to what? Yeah, they are contributing to a defined contribution. So it's going to be plus 1,800,000. So this is going to give you the total remuneration. The total remuneration. Then you divide it by 260. How much are we going to have per day if we divide it by 260? So it's going to be 15 million plus 1,800,000.
$64,615.
You get how much? 64?
615.
615, right? Then what else
Yes.
do we do when we have this one? We now have to, this is a total 64, then we divide it by the number of employee times 111. So it's going to be how much there? $64,615. So it's going to be how much here? I got on my side, I got so which means here we are going to have so which means here we are talking of employee benefits. Then we have short term. Then we have post-employment benefits. How much did we say are the post-employment benefits? We say it's 1,800,000. Am I correct? 1,800,000. So it's going to be an expense. And this one, when you have your short oh, there's something wrong here. We need to fill in here on our calculation. So the current one is going to be how much here? The current leave accrual. I got here 102 461. You can round it to 461. This is the current one. So what is going to be our short-term employee benefit? So it means we say 15 plus here minus here. Then it gives us the short-term employee benefits. So it's going to be 15 million plus 102,461 minus 41,026. So it's going to be 15. So our short-term employee benefits is going to be 15. I have 15,061 061 435. That's our short-term employee benefit. So which means on our short-term, we are going to take this figure. Then on the post-employment, we are going to take this figure to our disclosure of the profit before tax. So that's basically how you do your disclosure. I think our time is over. Let's just end here. You guys, you can check here on this, on the accounting policy. Check on the accounting policy. We don't know what is gonna come. This one, number 7, is not a problem. This is just psycha ethics. So this is part of our auditing. I want you to check on the change in accounting policy. Because the question is saying, this guy, he presented this thing. A junior accountant, he has presented this thing. So I want you guys to check if it is correct. But you can see it's incorrect because you can check here. If you check from the question, there was a change in accounting policy from first in, first out to weighted average method. And then here they say SARS. This statement is very important when you are checking. The South African Revenue Service will not reopen the previous year's tax assessment, but will accept the new policy in respect of the taxation. This statement is very important when you do your deferred tax. If they are not going to reopen the previous year's tax assessment, it means you are going to have deferred tax here and here. That's basically what it means here. Then this change in accounting policy has not been accounted for as yet. However, the financial accountant has drafted a change in accounting policy to be disclosed in the financial statement. Right. So if you check, this is what this guy has done. So what you need to do when you're answering this kind of a question, the first thing is you need to know the disclosure. How does the disclosure in the accounting policy look, change in accounting policy looks like? So that when you compare it with this one, you can now be able to see it's wrong. So what is wrong on this one? By the looks, without even doing much calculation, this thing is wrong. Because if you check on our here, automatically this is wrong. Increase or decrease in cost of sale. you should have an increase in decrease or cost of sale. Here you cannot have deferred tax in 2024. You can only have deferred tax in 2023 and 2022 because in 2024, SARS is going to use the change in accounting policy, which means the tax base and the carrying amount are going to be the same. So in 2024, there is no deferred tax. Then in 2023, we have a deferred tax because the carrying amount of the inventory and the tax base are going to be different. So these are the things that you should look at. And when you come again to equity, when you are doing your checking, also check when we record equity, we don't record it like this. We take the equity of the previous year, it will be here at the beginning of the current year. Remember, when we say a change in accounting policy, we do a retrospective correction of the financial statement. So which means this one will be here and this one will be here when we come to the equity. Right. I think that's how we do up, but I want you to check it, comparing it with what we did in class. Just compare this with what we did in class and you will see what is wrong here. You can even see again what is wrong here is we don't have current tax expense here. There is no current tax expense. Even in the cost of sale, you can see there is also an error there on the cost of sale. We don't record the difference between 790 and this one as the cost of sale. We record increase in cost of sale, which means the difference here and the difference here, then we see the increase. This is what we are going to record. So those are some of the errors that you will see when you cross-check this. Right, I think we should just rest or go through whatever you guys think can help during tomorrow. And for now, I think we can rest and meet and see tomorrow what is going to happen tomorrow. Unless if there's someone else who has something to say, I think we have to close the class. Anything to say before we close the class? I'm gonna close the class now.
You can borrow as your medulla oblongata.
Mine is too old. You can't
No ways. It's not.
It's too old. You can't. It will be heavy. You'll be like walking like an old woman.
That's the
Come
one
on.
we need with experience.
Exactly.
Okay, so it's fine. Tomorrow is fine. We'll meet tomorrow. You guys, you just send as usual. Then we see. We don't know what is coming. Remember, these guys, they don't tell you the scope. So we'll see when the paper comes.
I have a feeling we're gonna get group accounts. I don't know.
No, we didn't do much on our side. We didn't do much on group accounts. If they come, we'll see how we can assist each other on them. Because we just do introduction. We didn't go deep into group accounts in our class. But if they come, I think we should just see and we'll prepare them when we do our final exam.
Thank you, love Mo.
Okay, tomorrow. What time is tomorrow? 8:15, 8:30?
8:30,
Okay.
I think.